Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone that you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and happy Sunday. Giving you sincere and actionable ideas is what we do every single week. You heard that website, getretiredstayretired.com. That's getretiredstayretired.com. Well, holy cow, 6 months is in the books. We got 6 months to go. What are the things that you can be doing to get good results in your portfolio and continue to move the needle? And remember, our theme of the year was pragmatic optimism. Our implementation thesis, diversify your diversifiers. But we got to look back just a little bit before we go forward. And I think there was a defining word for the year. The defining word for the year, some people think it's big and it's beautiful. The word is tariffs. Tariffs, 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 tariffs. That's what's been in the news. That's what's been out of the news. But it's interesting that the tariffs have created something. It's created a tale. I call it once upon a time. Yes, once upon a time, you too lived through 3 markets in just 6 months. 3 markets in 6 months? Oh, yes. Market number 1, Trumponomics. And it was January and February. And it was nothing short of glorious. It was security, pro-growth, deregulation, the promise of tax cuts, which have now arrived. And the market celebrated Trumponomics by coming out of the gate with strong returns for the first 60 days of the year. But unfortunately, Trumponomics ended after just 2 months. And it was replaced with something else. It was replaced with recession paranoia. And that recession paranoia was due to all of the issues that we saw, the 25% at automakers, everything that came through on Liberation Day, everything that played out publicly, the bond vigilantes coming in and hitting treasuries. It was a very tough March and a very tough April. But thankfully, once those April showers were over, we sprung some May flowers. And that got us into market number 2, focus on the positive. And the focus on the positive is everybody said, you know what? These probably are negotiations. Trump is doing negotiations in the same way the Bears said they were leaving Chicago in January. And then in April, they said they were going back to Chicago. And then in May, the Bears said, nope, we're definitely leaving and going to Arlington Heights. Sounds like a lot of flip-flopping on the behalf of the Chicago Bears. Well, maybe it was negotiation in the same way this administration is negotiating trade. But the third market, we're talking about the fact that you have just lived through 3 markets in 6 months. Trumponomics, recession paranoia, and then market 3, which is where we still are, focus on the positives. And I think what people are focusing on the positive is this. It's all artificial intelligence. Accept it or not, it is here. It is enhancing the human experience. It is not yet replacing it. And the mass amount of innovation, that cost of innovation, because innovation comes at a cost, R&D, research and development is not free, is helping to propel things forward. So that's my top-down summary. I wanted to bring in one of our top wealth advisors at VestGen Wealth Partners, David. David, as you look back at that first half of the year, the 3 distinct markets that everybody lived through, what are some of the lessons and takeaways that you have as a professional advisor from this period of time?
Yeah, I mean, we called the first, 6 months, like I think our other thematic was things change quickly. And we can't let emotions drive decisions. Data drives decision making. And for those that held on tight through March and April, they've been rewarded for that because we still have these very powerful long-term themes backing the market. You just named one, which is AI and the tremendous amount of spending. So I think lesson number one, call it lessons learned from the Rose Garden, is don't put politics in your portfolio. Let the data drive the decision making. And look, we're not saying that things are rosy, but I certainly think the sky is not falling. And the underlying driver of that is the jobs data has been okay. It's not great, but by historical standards, it's been good enough. And jobs numbers are correlated to consumer spending. So if people have jobs, they're spending money. And that's one of the things that Americans do very well. We're probably not the best savers, but we are tremendous spenders. Now, there's a difference between job sentiment and job numbers. Job sentiment is terrible. People don't feel good. But the hard data, the actual unemployment numbers, those are good. And the spending's been good enough. So I think that's the first takeaway is if you have a plan that's data dependent, you probably didn't get spooked out of the market. I think the second takeaway is if you have a plan that's data dependent, perhaps that was an opportunity for some folks. Now, I don't think that opportunity needs to be getting in and out of the stock market, but I think it was a great opportunity if you were a little bit tactical to make some swaps. I'll give 2 examples. Number one is you probably could have made some really tactical bond swaps by taking a bond, like a municipal bond from, I don't know, just make it up, Texas, that may have gone down in value, and replaced it with a bond from Georgia. Why would you do that? You wanted to book the tax loss, and you just traded a very similar bond with the exact same yield. So that would be part number one. Part number two is think of all the stocks that went on sale that are part of these big thematics. Some of those big FANG stocks were down double digits, 20, 30% off their highs. If you believe in those big thematics, it was a great opportunity for some folks to, maybe change out some of their value stocks for some of these high growth stocks with a significant arbitrage between where those two were trading. So these big volatile markets, while they spook a lot of people out, what we know is a lot of people used it as an opportunity. In March and April, saw some of the biggest retail inflows into the market that we've seen in the last several decades.
So we're talking about the mid-year outlook from VestGen Wealth Partners. And we covered the 3 markets you just survived in the last 6 months. Trumponomics, which were glorious, followed by recession paranoia, followed by the current state of affairs, which is focus on the positive. And I think the learning lessons that you just heard from our wealth advisor is 1, panic is never an option. 2, politics don't have a place in your portfolio. And if you want to learn more about how to do the things that David mentioned, tax swaps on fixed income and various other strategies to make sure you too are getting what's important, Tax Alpha, go out to our website. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. And yes, the old school phone number still works, 833-964-PLAN. That's 833-964-PLAN. So, David, you said it, and I want to second it. Hey, everybody got so worried about this technical recession just because the GDP turned negative in the first quarter. It was an aberration. It was negative GDP because all these big companies, these retailers that could do it, like Walmart and Costco, they got in advance of the tariffs and they pre-bought their inventory because second quarter GDP, we're going to get it at the end of the month. But guess what? It's nice and positive coming out of the Atlanta Fed's predictive model, which means no recession. The soft landing stays intact. Second, David mentioned it. I just want to acknowledge it. It is the strength of the American consumer because guess what? This jobs market, boy, it looks good. A very tight range, 4 to 4.2% over the last 12 months. That might not be Goldilocks, but it's pretty darn close. And remember, when people have jobs, they turn into consumers. That's all the spending that's occurring. In addition to that, we mentioned that the cost of innovation is large, and some wonderful things are here. The One Big Beautiful Bill does give retroactive to January 1st research and development credits. That means companies are going to pour more money into AI innovation. In addition to that, we have some accelerated depreciation expense, which is a part of this tax law. That too is going to help businesses propel further, and all of that is very, very good news. But what you're probably thinking is, how do I harness this information? How do I harness markets that move faster than they've ever met? How do I take advantage of all the various things that are in the new One Big Beautiful Bill? Because you too want your part of that 40,000 salt shaker. You too want to find strategies to get to the power of 0% dividend tax, 0% capital gains tax. I'm sure you too really are saying, is it true that my overtime income is no longer taxable? Is my tip income no longer taxable? Maybe you're turning 65 this year. Maybe you're already on Medicare and you're saying to yourself, am I going to get the $6,000 above the line deduction, aka the enhanced standard deduction? Well, you may or may not. It depends on your income. So those are all things that we're going to be covering later in the show. But if you want to find out more, you absolutely can. Give us a call, 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. When you're on that website, I encourage you to download our 2025 tax planning guide. The 2025 tax planning guide is chock full of strategies that you need to maximize your savings. And when you download that guide, we are very close to pushing out all of the strategies that you need to be incorporating as a result of the One Big Beautiful Bill. By downloading that guide today, you will automatically get the new fact set when it becomes available. You're listening to Craig and David in the Know with VestGen Wealth Partners on AM 560.
More in the Know Radio. You want more in the Know Radio? You can handle more in the Know Radio. Okay, yeah, you can. And it's on AM 560. The Answer. Welcome back. Here's more with Craig.
You know, innovation's a tricky thing, but remember, innovation leads to disruption, and through innovation that causes disruption, we think it's a long-term secular investment trend. And there's some things that we have learned the hard way. In fact, I'm going to name a couple of things, and David, I'll encourage you too as well. David, COVID, right, wrong, or indifferent, it taught the world some things. Number one, it reminded people that, boy, this isn't good. That OPEC controls 90% of the known oil reserves. Because maybe people don't remember, but we had some issues with oil during COVID. David, you have long talked about that semiconductors are too concentrated. Briefly, where are they concentrated at and by how much?
Yeah, Taiwan produces 60% of logic semiconductors.
Oh my God. So Taiwan drives 60% of all the semiconductors, the smart chips that people need to run everything these days, from the toaster, the microwave, the automobile to national defense. Wow. And, you know, the other thing we saw, David, is all forms of PPEs, disposable gloves, masks, everything else. Where are those manufactured and what percent?
75% comes from Malaysia.
75% of PPE just comes in Malaysia? Whoa, India produces 60% of the global vaccines? Wait a second, you know what? See, large issues create opportunity. Because what's happening now, you're having everyone say, wait a second, we can't have these supply chains so concentrated in just 1, 2, 3 countries for things that are deemed necessary and material. And that's where some of the brilliance of tariffs and onshoring comes from. It's about controlling the supply chain so a country and its citizens aren't left in a lurch. You know, the other thing that I think about is this. I think about the development of all of these mega trends, right? And David, we've long talked about participating in various mega trends, whether those be digital payments, because how many people are using cash? Not that many. Lots of people are still swiping credit cards. I do. But how much money gets transferred through digital payments? I didn't say digital currency. I said digital payments. Think Zelle. Think Chase Pay. Think Square. Think Apple Pay. All of these are investable themes, are they not, David?
Yeah, I mean, now that I'm thinking about this, I was at a restaurant a couple of years ago. I pulled out my wallet to pay with cash, and the server said, "Oh, I'm sorry, sir. We don't accept cash. You have to pay with a credit card," which I was more than happy to do, but things are changing, right? I mean, if you don't accept cash, I think that's like, okay, we're moving the needle here. And now that we've seen different states adopt crypto and all of the stuff, whether or not that turns out to be what the long-term solution is, clearly we're moving in that direction. And I think for security reasons, national security, right? If there's going to be a trend, like the US needs to be there. And I think that's why you're starting to see things really change. You're starting to see big investment firms, the Fidelities or the BlackRocks of the world, create these new platforms. They're putting dollars in because they know it's going to be here. Might not be here in the exact same format, but it's coming at some juncture.
So I want to make sure we're talking about some mega trends, these mega trends that come from innovation that creates disruption. And a big part of COVID-19 was disruption and exposing things that needed to be solved for. And if you're interested, I think we should have discussions about how you too can invest in these mega trends. Megatrend number one, digital payments. It's coming, it's here, it's widely adopted. You need to understand that infrastructure. Megatrend number two is, of course, artificial intelligence. And it's not just owning the semiconductors. It's not just owning the data centers. It's not just owning the fiber optic networks, the cell towers. It's also owning what? Because all of that's got to get powered somehow, doesn't it, David?
Yeah, it's about the infrastructure to power that and then to transfer that data. So think cooling systems, fiber optics, right? And if you think about it, I mean, some of these data centers, we're talking 500 acres, 875 acres, 1,000 acres. It's just like a data farm, right? It's not just a building. It's buildings connected over hundreds of acres. And that is going to require lots of different companies to put that together. And if there was a thematic that I would drive home with people, I think it's the core of people's portfolios probably needs to be the equities of those big cap companies to participate. So you mentioned like the semiconductor companies and things of that nature. But I think with the markets trading at all-time highs again, funny how we're right back there from, back to where we were in February, is let's think about perhaps transferring some of that equity risk to other players in those games that might be trading at cheaper valuations. Because again, this is everybody's second chance. Do you want to make changes when the market's down? We talked about that in the first segment. You don't want to be making changes in March and April when we have depressed stock prices. But now that we're trading back at all-time highs, I think now is a great time to say, hey, let's take some profits and let's move them to other companies, other investments, but under those same thematics. That's a really big theme for us the second half of 2025.
Absolutely. So if you want to learn 833-964-PLAN, that's 833-964-PLAN, go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. We're talking about how innovation leads to disruption and how that can create long-term secular themes, whether it be, of course, digital payments, artificial intelligence, and all the infrastructure that's going to need to support it. And David, if there's going to be such demand for AI, such an increasing nature of digital payment, cash transaction apps, then that means cybersecurity is an all-important thing. Talk about that from a mega trend.
Well, everybody's gotten letters in the mail of data breaches from all of these big companies. So I think we've all been exposed to it in some format, but the amount of money that's required to keep this infrastructure safe continues to increase. So when we're creating these thematics, it's not just one or two. We have to have seeds and plant seeds in all of these different long-term thematics because they're all kind of working together. The other thing I'll say, Craig, is when we learned about how reliant we were on certain countries for certain types of products, and we wanted to somewhat deglobalize and bring that back. And let's be honest, we have brought it back, right? We are now making semiconductors in Arizona through Taiwan Semiconductor and all of these things. That was scary for people. Some people were nervous to say, oh my gosh, we spent all this time building these global trade partners and now we're upending all the supply chains. I think the reality of it, though, is if there was a positive takeaway is a lot of these big technology companies are very reliant on each other, meaning that for AI specifically, there are certain things that will always probably be made in Asia, and there will always be thematics in parts of these semiconductors that are made in Europe. And then we in the US really produce what I call the intellectual capital. We're the thought leaders beyond that. So it's not as if we're going to just completely deglobalize. All of these big companies actually have partnerships because there's no one company that's doing everything. They're very interrelated, and that doesn't look like that's going to change anytime soon.
Fantastic. 833-964-PLAN, 833-964-PLAN, get retired, stayretired.com. So whether it's artificial intelligence, whether it's cybersecurity, whether it's infrastructure as an investable theme, digital payments, you also have to look at the study of genomics. I mean, we have the graying of America. We have an aging population. And I think the study of genomics is going to continue to expand at rapid pace. David, give an example of what we've seen already with how GLP-1s are transforming the globe relative to weight loss on the injectables. What might be next? That's a very investable theme, is it not?
100%, right? Everybody knows that, last year, most of those big healthcare companies were strapped. They couldn't produce those drugs fast enough. And for folks that really needed them for significant health reasons like diabetes, those companies were under siege because some people wanted perhaps those drugs for vanity. And now the companies have caught up, but the demand's not stopping. And the fact that you can access those drugs without having to see a doctor in person, you can just go online and get them. That thematic is going to be around here for a long time. And quite frankly, from an investment standpoint, if you're looking for value in today's market, I would say, generally speaking, healthcare is one of those sectors that if you kind of go through and look at the underlying companies, there's tremendous value in some of those underlying stocks. They've really been beaten down this year. So maybe good runs over the last 3 to 4 years, but good value today if you're looking to do some rebalancing.
Absolutely, because you too want to make sure you have enough of your money invested in innovation that leads to disruption, that creates long-term secular investment theme opportunities so that you can have not just tax alpha like we talked about in the last segment, but so that you can have performance alpha over time. If you want to learn more, you absolutely can. Go to our website, getretired.stayretired.com. That's getretired.stayretired.com. While you're on that website, I encourage you to download one of our useful guides like our 2025 tax planning guide, so you can make sure you have the information you need coming in the second half of the year, courtesy of the One Big Beautiful Bill. All right, more to come. In the Know, VestGen Wealth Partners, AM 560.
Dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
So we've been spending some time talking about our mid-year outlook and giving you some sincere and actionable ideas that you need to be thinking of, starting with level setting, the fact that we've lived through 3 markets in just 6 months, Trumponomics followed by recession mania, followed by where we currently reside. And where we currently reside is a very good place because we call that focus on the positive. We transition that into that theme of focusing on the positive, which is the tariffs, their negotiations, the intrinsic value that's being created through innovation, specifically AI, pairing that with things in the One Big Beautiful Bill like research and development credit leads to various megatrends that we discussed in our last segment, such as digital payments, the study of genomics, infrastructure, AI, cybersecurity, all of these are things that I think people need to make sure they have exposure of in portions of their portfolio. But I also think about, when we talk further about where we're at today, as we level set, kind of that mid-year outlook. Again, it is most probable that the soft landing remains intact. It is most probable that the recession that everyone worries is coming is going to yet again remain elusive. And that translates into 5 things for 2025. That's right, 5 things for 2025. And I think the first issue for many, and the first issue for you, should be this. The avalanche issue in American financial planning is and will remain all things that are long-term care. All things that are long-term care. And the lens through which we've discussed long-term care on this show time and time again is we worry about spousal impoverishment. If you're married, your best friend in life, your husband, your wife gets sick, needs some form of care in the home, some form of care into assisted living, some form of care into skilled nursing, that first spouse who gets sick, they always get what they need. They get what they want because you're going to spend the resources for your most treasured loved one to get exactly that care where needed. The problem ends up becoming is spousal impoverishment's a very real thing. I worry about the healthy spouse. Once that journey is over for the spouse who got sick, are there enough resources still there? And that doesn't mean you should run out and buy long-term care insurance. No, it does not. But it means you have to solve for this issue. You have to solve for it. And you're going to consciously solve for it by either self-insuring or you're going to partially insure. And that's what I think is exciting. I just mentioned that the problems about increasing premium risk in long-term care policies is no more, as there are solutions in the marketplace that allow you to simply buy the policy one time, write a check, pay for it over 3 to 5 years, and it's fully paid up, no premium risk at all. Objection number 2 has long been, I don't want to put money into any form of a partial long-term care solution, because what if I die without using it? Well, the good news is if you die without using it, the money is not lost. The money goes to your beneficiaries. Third, what if something crazy happens? Like we have single payer for all. We end up nationalizing healthcare. We crowd out the private marketplace. Heaven knows I would never want to see that. But if that happened, isn't it nice that you have an off ramp whereby 15, 20 years later, if you needed to cancel or wanted to cancel the policy, you could get your money back? All of those just means there's tremendous optionality today to start addressing. You'll never solve it, but you can start addressing the risk, the very real risk that is spousal impoverishment, the risk that is about protecting choice, allowing you to have care in the home when needed, allowing you to get the type of care you might need as you age, because the nuclear family still exists. I love to protect it, but it's decentralized. No one lives on the same block anymore. Everyone's spread all across the country, and it's tougher and tougher to be reliant upon family for these issues. If you want to learn more, you absolutely can. You got to reach out to us at 833-964-PLAN. That's 833-964-PLAN. Go to our website, getretiredstayretired.com. That's getretiredstayretired.com. And when you're there, download our short introduction to long-term care. Download our short introduction to long-term care so you can start getting empowered with the information that you need. David, we're talking about our 5 for 25. David, what's next on your list? What might number 2 be?
The battle between hard and soft data will continue. And when we talk about that, what we're really talking about is the way people feel versus the actual numbers that we get on a monthly or weekly basis. We know sentiment has been pretty much in line where it was during the height of the COVID pandemic. And in April, it was close almost to where we were in the 2008 financial crisis. So clearly there's this feeling from folks on Main Street that they just maybe don't like what's going on in a lot of cases. But the reality is the economic data doesn't match the way people feel. Consumer spending's still been good. The economy's okay. And markets climb a wall of worry. So that's not going to change. We feel the same way. There's conversations I have with my wife all the time, like, I can't believe this cost that much money. So there is this feeling on Main Street that things are getting tough. But what you haven't seen is you haven't seen people stop going to restaurants. You haven't seen that global travel slow down. It continues to go. And if that's going to be the case, then we need to have some risk assets in the portfolio. My suggestion is don't expect a big change. This is just the way it's going to be for the foreseeable future.
And that gets into, I think, number 4. We might have touched on it earlier, but as we talk about our 5 for 25, solving, or this gets to number 3, I'm going to go get a coffee, my friend. Yes. So you know what, David? Even I make mistakes once in a while on a Sunday morning. It just happens after a good dinner party on a Saturday evening. So we're talking about our 5 for 25. Number 1 on our list was solving for the existential crisis that is long-term care in America. Number 2, we just got done discussing soft data versus hard data and why data-driven decisions should be the dependency that people use. But lesson number 3, lessons from the Rose Garden. What's lesson number 3 on our 5 for 25, David?
Panic is never a strategy for stock investors. And I think what April proved, and we now have lots of data to back this up, some of the best days in the stock market follow some of the worst days. And if you sell out on some of these really, really bad days, you are likely going to miss a significant rebound in the forthcoming days. And that's exactly what happened, right? Didn't we have one day, Craig, this year where the market was up 9% in one day? I mean, if you're off by that one day, you probably ruined your performance over the next 12 months, right? But that's how tricky this gets. So I think the takeaway is markets give people a second chance, and the time to prepare for more difficult situations is before they come. So number 1, long-term care. If you're thinking about long-term care, the time to do it is now. The market's up. You want to rebalance your portfolio, rebalance it, handle your long-term care. You have to do the rebalancing when times are good, not when times are poor, right? So maybe that's your way to rebalance is you want to get this long-term care done. And from a cash flow perspective, the time to build cash in your portfolio is today. The market's trading at all-time highs. If you're light on cash in the bank, cash is an asset class. Doesn't always feel great if it's not earning a lot of money and the stock market's up 6-7%, but cash is a valuable asset class. I would say, and I don't know how you feel about this, Craig, but it's very hard to build cash in retirement. So rule number 1 is you gotta have that cash built up before you retire, because if everything's in your 401k, it's not really easy to create additional cash. So I would just use this as an opportunity. There's no need to panic. If you're very thoughtful, now is a great time to rebalance. And we learned from the Rose Garden that markets change quickly, and now is a good time to kind of level set.
833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. We're here to help you get retired and stay retired. And that's because you deserve not just to survive retirement. I want you to thrive in retirement. And that's going to take a disciplined, data-driven approach that is TNT, tested in the trenches. We're going to talk more about our 5 for 25 when we come back. VestGen Wealth Partners, In the Know, AM 560.
In the Know Radio with Craig Balanas on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
If you're just tuning in, we've been talking about 5 for 25. Number 1 on our list, continuity of care. How are you going to solve it? And the tools and accessibility. And I think the timing to do such is now. Number 2, the reminder that the battle between hard data and soft data is going to continue. That's why markets climb walls of worry. So be mindful of sentiment, embrace data-driven decisions, and you too will get the consistency of results. Number 3, there are significant lessons learned from the Rose Garden, courtesy of the 3 markets that you lived through this year: Trumponomics, recession paranoia, and of course, the current marketplace that we're in, which is focus on the positive. But we're on number 4 of our list, David. And number 4 on our list of 5 for 25 is what?
Triple B, big, beautiful bill.
Yes.
And
the one big, beautiful bill.
I know there's some negativity around that, but what we got to drive home is there are some major changes that are unbelievable benefits for Main Street retirees. Granted, they're going to probably be short-lived, right? A lot of these are only over the next 3 years, but we gotta live it up while we can. And whether or not this is going to be good for the long-term finances of the U.S. and A, we'll see it. But I think right now, let's just give people some actionable ideas of how this is going to benefit for them. I'll give you number 1, which is we have a permanent extension of the Tax Cut and Jobs Act. Now, by permanent, I mean permanent for the next several years until there's probably a leadership change. But that's keeping marginal rates right where they are for the foreseeable future. And if we're honest with ourselves, the existing marginal tax rates for individuals are some of the lowest we've had since the 1980s. So this is extending everybody's opportunity set to consider doing additional Roth conversions, because we know a lot of people were racing to get them done prior to 2026. This just gives everybody a little bit more runway to do small conversions over several more years.
Absolutely. Number 2, piling on the one big beautiful bill, that SALT cap increase. That SALT cap increase just went to $40,000, which is nothing short of fantastic, because I know you're frustrated. You might be in Lake County, you might be in DuPage County, you might be in Cook County, and your property tax bill eclipses $10,000, not to mention the taxes on your wages, your dividends, your interest, your capital gains, your rental income. The fact that you now can go ahead and deduct up to $40,000. That's gigantic, but you got to make sure your income's going to qualify you. So yes, the one big beautiful bill has some complexities. It expands all these deductions, but your income has to qualify. That's why you need to be working with firms that are going to help you engineer your tax return for a predefined outcome. Because wouldn't it be a shame if you didn't get the full $40,000? Sure would be. If you want to learn more, you can. 833-964-PLAN. 833-964-PLAN. Get retired. StayRetired.com. David, I'm equally excited about something. It's small, but people should know this. We have a repeat of the CARES Act. There's a above the line deduction now for people who give smaller donations. I want to make sure people are giving right. Should you be using a qualified charitable distribution? Should you be using a donor advised fund? Should you actually be back to writing the first $1,000 or $2,000 checks just coming from your bank account? All of these things are things we can help you do, focus, and learn more about. But Dave, I think this is big. I call it the power of zero, because David, not all capital gains and not all dividend rates are the same, are they?
They are certainly not. And these extra deductions, like these enhanced senior deductions or senior bonuses, could set up some families to perhaps pay 0% on realized capital gains as opposed to 15%. This is a good stock market year. People will be taking profits, and we want to make sure that your income aligns you to capture all of these benefits. So this isn't about one thing. It's about linking several of these small benefits together.
And let me give everybody an example. So in case you didn't know, for people in the 10 and 12% marginal tax bracket, right now, capital gains tax is 0 and qualified dividend income is 0. And I know our listeners, David, are thinking, oh, I'm not there. Well, you might just be there. Say you had a married couple filing joint with $137,000 of total income. If that married couple filing joint with $137,000 of total income both happen to be 65 or older, then their standard deduction is $41,000, just about. David, you take $137,000 minus a $41,000 standard deduction. I don't know about the math, but I think that's 96 grand. And at 96 grand of taxable income, David, the dividend tax rate and the capital gains rate goes from 15% to what number?
0.
America, That's tax leverage. So what are you doing between now and the end of the year to engineer tax leverage? 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com, and download that 2025 tax guide.
Craig, I want to jump in real quick and just put this disclaimer on this that, with the big beautiful bill, there's lots of information floating out there on the internet that this is what investors or retirees should do now. And the advice is kind of broad-based and everyone should be doing this. But what I would suggest to people is you do have some competing interests with all of these things. So you just mentioned, oh my gosh, with this huge deduction that a lot of people might qualify for, you might have 0% capital gains treatment. That's unbelievable. We want to take advantage of that. But if you're also looking at doing Roth conversions, that's generating more taxable income. So the two don't always work together. And I think this is what we always try to drive home on the show is there's no one size fits all solution. What we have to figure out is what's most important to your family's tax return. And then we create a strategy to go ahead and handle it. So yes, some people, they might need to do these Roth conversions because it's a huge benefit for their family's bottom line. But for other folks, it might be more important just to qualify for zero taxes on dividends and zero taxes for capital gains. So I want to just keep that in mind this morning as we're talking about this.
You deserve something that's customized to you. And that's why I think everybody deserves a multifamily office. You need to work with not an advisor. You need to work with a team of advisors that are all under one roof that can provide those multi-disciplines that you need. Yes, that's the investment advisory services under a strict fiduciary standard. That's the cash flow and goals-based modeling done under the CFP standard of care. That's making sure the income tax work, the likes of which we're discussing now, what the one big beautiful bill means to your family, to your 1040, because yours is different than your neighbor's. And how does that tie into even the significant changes that are in the one big beautiful bill relative to estate, death, and transfer taxes? And that's something we do, and we do all of those things well at VestGen Wealth Partners. If you are family-centric, have traditional values, know what it means to be comfortable, non-flashy, and you just find yourself wanting to do better because you know you can do better. Because to each and all of us, doing better is against our own potential. I want to invite you to unlock that potential by working with us in a collaborative relationship. Everyone on the team has a heart of a teacher so that you can be empowered with information. Not to be told why to do something, but so that you can seek to understand how those things would benefit you and yours, because that's what we're all about. And I always say the truth is self-revealed. So get in touch with us today. We're a phone call away. That's 833-964-PLAN, 833-964-PLAN. Connect with us online. Get Retired. StayRetired.com. That's GetRetiredStayRetired.com. The leverage oftentimes comes from tax planning with incremental wins at the margin strung together over a series of years to allow you to thrive, not just survive in retirement. So download our 2025 tax guide today. More to come. AM 560, The Answer.
Get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
We spent our day talking about some of our mid-year outlook, and we're rounding it out with our top 5 for 25. That was the discussion on long-term care, making sure you understand hard versus soft data, all the lessons learned from the Rose Garden, what you need to be more effective courtesy of the new tax law that is known as the One Big Beautiful Bill. And that brings us to number 5, diversify your diversifiers. David, most people have done a decent job, maybe not a bespoke job, of curating a diversified portfolio of publicly traded stocks and bonds, but they're missing the next market. They're missing the next opportunity set, which is all of these great investable ideas that are not publicly traded, but they happen to be private. How can VestGen Wealth Partners help bridge that opportunity set for the families we serve?
This is what I refer to as leveling up your investment strategies. Level 101 is basic diversification, as you mentioned. I think everybody's got that down. Level 201 might be adding some liquid alts. A lot of people have added gold. We own gold in several ETF strategies. But the level 301 has to do with what I call transferring equity risk. So we believe in a lot of these long-term thematics, innovation kind of being the overarching theme of that. And when you think about it, a lot of the companies that are at the forefront of innovation and AI are not publicly traded companies. We know together that ChatGPT, OpenAI, has raised more money than I think all of the 170 IPOs in 2024 combined. So one company raised that much money. That's how much people believe in this stuff. But as a Main Street investor, you can't go out and just invest in that. It's not a publicly traded security. So what I would encourage everybody to do is to think about how they can get access to some of these most innovative companies, the companies that you might actually work for, these smaller companies. And the best way to do that is through private investment strategies. And if there is one takeaway for private investment strategies today, it's that the excess return of private equity has been highest when public equity market volatility is the highest. Said another way, private investment strategies tend to have their best performance when the markets are very, very wishy-washy. That might be where we're headed, and you deserve some of those private investments in your portfolio, but you've got to find a team like VestGen that's been doing it for more than 2 decades. That's what we do very well, is to curate those portfolios that are level 301, not just the level 101.
It's the time to learn about private markets, and VestGen is your institutional partner and gateway to do just that. 833-964-PLAN. Get retired, stay retired.com.